Hi guys, good afternoon to you all. I hope everyone's well. Let's get ready for the session ahead, and it's going to be dominated again by housing. The main event really today at 3 o'clock, the new home sales. But let's just talk about yesterday. Well, first of all, these downward trends I was showing you yesterday are all very much still the order of the day. Things trending lower, new lows set yesterday across the risk assets, new highs set across the safe havens, such as the bond markets, obviously, with the Bund trading above 134 now, which is, madness really. But the yields on these G7 10-year government bonds are, well, to say the least, extremely low. So the trend channel I've got, let's zoom in on the stocks first of all and talk a bit about yesterday. The trend channel I've got in place over the last few sessions is kind of still intact. We did dip below it briefly yesterday on the economic data on the existing home sales at 3 o'clock. We set a new low at 1044. It's a new 7-week low for the S&P, breaking through key resistance, key support I should say, around about the 1050 area, which were the lows going back to the 20th of July. Okay, so we haven't traded these levels since the 7th of July, and in fact the closing level yesterday was the lowest close since the 6th of July. And in fact we've only really had, well, a handful of closes around about the levels that we did yesterday. We've only had a handful of closes on those prices this year. So things definitely continuing to the downside, the flight to quality continuing. Just looking at this chart, of course, you'd say that, well, obviously, bad economic data yesterday, stocks move lower. Simple, right? But actually, it's never that straightforward. And I want to just zoom in a little bit to a 5-minute chart just to kind of talk about the price action yesterday and what happened and why. Because it's always a little bit unusual to get market reactions the way we did yesterday, and it's difficult to explain it, but I'm going to give it a go right now. So, things were moving lower into the key event yesterday, which was the existing home sales. So the existing home sales number was, nothing short of a disaster. It was the lowest number of existing homes sold in a month, the lowest since 1995. Okay, so you don't need me to interpret that as being activity in the housing market being phenomenally low, and this is really due to the fact that the tax credit expired at the end of April, and we saw it in the new home sales, which is just seems to be had a bit of an earlier impact on the new home sales, and it fed through to existing home sales for the month of July, which have just fallen off a cliff. And going into that data release, people were very, very nervous. We were trading right on that key level. If I put it on this chart here, it'll be easier to see. Right on the key level, around about 1050.50. That was the low from the 20th of July, and we'd gone right down and tested that level just before the cash open. We were bouncing around, and going into the data release we were right on that level. A lot of nervousness around the markets. I'd spoken about that support level being very, very key ahead of that data. The data hit, and it was very, very bad news. And what always happens with any market is you'll get an initial knee-jerk reaction which will go in the direction that everybody anticipates, i.e. lower. So big spike lower. We hit 1044, which was one of yesterday's pivot levels. I think it was S2, or it might be an S3. I don't recall exactly, but it was a pivot level that did the job of holding up the market on that initial spike lower. Then what happened was not what you would expect, and what happened was not what the theory books would tell you, because we retraced the entire move, and that wasn't even enough, because we then went on to rally over the course of the next 2 hours. We moved up to 1058.25, which is a good considerable distance above where we were trading prior to the very bad economic data. So why did that happen? And there's two reasons why this happened. There's two reasons why equities, after an initial spike lower, moved higher and actually went on to move above where they were trading before the data. Reason number one being the movement of the dollar. We saw the dollar weaken across the board yesterday following the economic data. Okay, so the initial reaction of the dollar was weakening because this data release is specifically bad for the US economy. Therefore, dollar weakens. Also, another reason why the dollar weakened and another reason why equities rallied was the fact that this data release was so bad that it might actually be the catalyst, it might actually be the trigger for the Fed to decide that further quantitative easing is required, and the QE light, as it's being called, which is what they're undergoing at the moment, which is really just rolling over their QE1, which was the quantitative easing measures put in place last year. The QE light may well not be enough, and they might actually need to start QE2. So, of course, quantitative easing is a dollar weakening scenario. So that added to the dollar weakness yesterday. It also added to the stock market rise. Okay, so the reason why stocks rose because of the dollar is the correlation that's in play at the moment. Equity markets are inversely correlated to the dollar at this point in the economic cycle. The dollar is a safe haven. Equity markets are a risk asset, risky assets. Therefore, when you get flight to quality, you get dollar strength, you get equity weakness. So when that dollar does reverse and actually starts weakening because of the flight to quality correlation, equities strengthen. That's why in the short term yesterday equities rallied, okay, because of the weakening dollar and because of the potential for further quantitative easing from the Fed. We moved up to 1058.25. This is not easy trading. Going long equities off the back of disastrous economic data is not something that's easy to do. It just doesn't feel right. So it's really, you've got to be so careful. It's so dangerous, this type of move. You just cannot be stubborn. If you keep shorting equities, keep on shorting, booking loss, keep on shorting, booking loss, you know, it's like hitting your head against a brick wall. What we saw yesterday, and I did talk about it during that rise in the equity markets, it was all about waiting for that dollar weakness to come to an end. Okay, and it did eventually. And if I just zoom forward a little bit, we ended up selling off into the close. Well, we really ranged, I guess you could say, following the data release. We were in a range yesterday between 1049.75 and the highs up around 1057, 1058. So we're just as I speak, we're kind of just sat underneath the bottom side of this range right now. We're trading 1047.50. So very difficult session in terms of the equity market movement yesterday, all because of these correlations in the market and the havoc that it creates. And we had the scenario of equities rising off the back of disastrous economic data. Not easy to trade. Okay, well, let me go back to the hour chart. And actually, no, let me talk about the euro movement first of all yesterday after the data release to really emphasize what happened with the dollar. Okay, so again, let me zoom into a 5-minute chart here. So I just want to zoom in on the short-term price movement. Okay. So here we go. Here's euro dollar from 11 AM through to about 7 PM last night, and it was one-way traffic from 3 o'clock onwards. Okay, dollar weakening, and we had a huge move with the euro dollar moving from 126.15 and right up to, well, about 3:30 we set the high at 127.19. Okay, so this is dollar weakness because of the economic data release. This movement created the upside in equities initially. Then we kind of flatlined, and if I just zoom forward, I want to talk about the dollar and how you trade it during these types of issues, because look what happened last night. We retraced the whole of the move, so dollar strengthening again. And why does this happen? And if you read my strategy report today, I tried to touch on this relationship, and it's not easy to explain it in such a short strategy report, but essentially there's two sort of influencing factors on the dollar. During sessions like yesterday, the dollar really is being pulled from both sides. So first of all, you've got bad US economic data, which of course is bad news for the US economy, which is bad news for the dollar, especially if it will trigger further quantitative easing from the Fed. That's dollar weakness. That's what you see on the left hand side of this chart. The euro dollar rising aggressively, okay, dollar weakening. But eventually what tends to always follow through is the overriding global flight to quality. Because if you've got bad US economic data, that's bad news for the US economy, of course, but it's also very bad news for the global economy because of the dominant force that is the US economy. Okay, so the global flight to quality trade means dollar strength. So initially yesterday we got dollar weakness because of the specific damage to the US economy and possible quantitative easing. But eventually, and don't get me wrong, it took a hell of a long time, eventually the global flight to quality move came in, and that all that dollar weakness we'd seen after the data release was given back.